The Pakistan Stock Exchange, or PSX as the cool kids call it, is like the boisterous bazaar of Pakistan's financial world. You've got your usual suspects, seasoned investors, day traders trying their luck, and companies looking to raise capital. It's a chaotic dance of numbers. And like any good dance floor, you need some bouncers to keep things from getting too out of hand. That's where the concept of security comes in. In financial markets, security isn't just about stopping the odd pickpocket. It's about maintaining the integrity of the whole system, making sure everyone feels confident enough to keep dancing. And one of the tools these financial bouncers use is something called a circuit breaker. Now, you might be thinking of that weird electrical switch in your house that trips whenever you try to run the microwave and the vacuum cleaner at the same time. And you wouldn't be entirely wrong. A circuit breaker in the stock market is kind of like that, but instead of stopping your appliances from overloading, it halts trading when things get a bit too heated. It's like a timeout for the entire market, giving everyone a moment to catch their breath and reassess before someone does something rash. Think of it as the financial equivalent of separating two toddlers fighting over the same toy truck. We're talking about a system designed to prevent those financial heart attacks. Those moments when the market plummets faster than a pigeon trying to avoid a toddler with a toy truck. You see, when panic sets in, investors can start selling off their stocks like they're going out of style, which in turn can send the market into a free fall. Circuit breakers are meant to act like a safety net, a pause button, a chance for everyone to regain some semblance of sanity before things spiral completely out of control. So let's delve into the potential benefits of these financial safety nets, shall we? First and foremost, circuit breakers are designed to protect your hard-earned investments. Imagine you've poured your savings into the market, hoping to build a nest egg, perhaps retire early, and finally write that novel about a talking gecko who solves crimes. You're not looking for a wild roller coaster ride, just steady growth. But then, the market takes a nosedive. Panic ensues, people start selling off their stocks, and suddenly, your retirement fund looks more like a kid's piggy bank after a particularly aggressive raid. That's where circuit breakers step in, halting the free fall and giving the market a chance to stabilize. Think of it as a financial pressure valve, releasing some of the steam before the whole system explodes. By preventing these dramatic drops, circuit breakers help safeguard your investments from sudden, panic-driven losses. Now let's talk about market manipulation. You know, the shady stuff that gives the financial world a bit of a bad rap. Imagine a group of unscrupulous investors decides to artificially inflate or deflate the price of a stock, potentially making a killing at the expense of everyone else. Circuit breakers can act as a deterrent to these sorts of shenanigans. By halting trading when prices fluctuate too dramatically, they make it much harder for manipulators to pull off their schemes. It's like putting a speed bump in the middle of their financial joyride, giving everyone else a chance to catch up and say, "Hey, wait a minute, something fishy's going on here." And then there's the issue of investor confidence. Markets thrive on confidence. When people believe in the system, they're more likely to invest, which in turn fuels economic growth. But when the market becomes unpredictable, when it feels like a game rigged against them, investors tend to get skittish. They pull back, hoard their money, and suddenly the whole system starts to sputter. Circuit breakers can help maintain that all-important confidence by providing a sense of stability, a reassurance that even in turbulent times, there's a mechanism in place to prevent a complete meltdown. It's like a financial security blanket, reminding everyone that the system, while not perfect, is at least trying to prevent them from losing their shirts. All right, folks, let's get down to the nitty-gritty, the potential downsides of these circuit breakers. First up, let's talk about overregulation. You see, some argue that circuit breakers are just another example of the government meddling in the free market, throwing a wrench into the delicate machinery of capitalism. They claim that these halts in trading can disrupt the natural flow of supply and demand, potentially distorting prices and hindering the market's ability to correct itself. It's like trying to micromanage a game of Tetris, constantly pausing the game to rearrange the blocks, ultimately making it harder to achieve that satisfying full line clear. Now, whether this overregulation argument holds water is debatable. After all, even the most ardent free market enthusiasts would agree that some level of regulation is necessary to prevent chaos and ensure fair play. It's all about finding the right balance. the sweet spot between letting the market do its thing and preventing it from turning into a financial mosh pit. And that, my friends, is a debate that's likely to continue for as long as there are markets to regulate. Next up, let's talk about costs. Implementing and maintaining a system of circuit breakers isn't exactly cheap. You need sophisticated technology to monitor market fluctuations, trigger the halts, and then restart trading once the coast is clear. It's like setting up a high-tech security system for your house, complete with motion sensors, alarms, and a team of security guards ready to respond at a moment's notice. And just like that home security system, circuit breakers come with a hefty price tag. Now you might be thinking, John, surely the cost is worth it if it prevents a market crash, right? Well, that's where things get a bit tricky. Remember, circuit breakers are designed to prevent those rare extreme events, those black swan moments that throw the market into a tailspin. But what about all the other times? Those days when the market fluctuates within a normal range? Are we spending a fortune on a system that's mostly sitting idle, like a fire extinguisher that only gets used once every decade, if at all? It's a valid question, and one that policymakers need to grapple with when weighing the costs and benefits of these financial safety nets. And speaking of costs, let's not forget about the potential impact on trading itself. Circuit breakers, by their very nature, introduce delays into the system. When trading halts, investors are left in limbo, unable to buy or sell until the pause is lifted. Now, for most long-term investors, this might not be a huge deal. They're playing the long game, riding out the market's ups and downs. But for short-term traders, those folks who make their living by exploiting minute-by-minute price fluctuations, these delays can be a real pain. It's like trying to run a marathon with a series of mandatory 5-minute breaks every mile. Sure, you'll eventually reach the finish line, but it's going to take a lot longer, and you might miss out on some opportunities along the way. And let's not forget about the psychological impact of these halts. Remember what we said about investor confidence? Well, some argue that circuit breakers, while designed to instill confidence, can actually have the opposite effect. Imagine you're in the middle of a trade, feeling good about your strategy, and suddenly, bam! Trading halts, the market freezes, and you're left wondering what the heck is going on. It's like being in a casino, on a winning streak, when suddenly the lights go out, the roulette wheel stops spinning, and everyone's left in the dark. That kind of uncertainty can breed anxiety, making investors question the stability of the market and potentially leading them to pull back, even if the halt was ultimately a good thing. It's a classic case of the cure being worse than the disease, a scenario where the very mechanism designed to protect the market ends up undermining it. We've explored the pros and cons, the potential benefits and drawbacks of these financial safety nets. We've seen how they can protect investments, deter market manipulation, and boost investor confidence. But we've also examined the possibility of over-regulation, implementation costs, trading delays, and the potential for unintended consequences. Like a seesaw on a windy day, the debate over circuit breakers is constantly shifting, with valid arguments on both sides. So where do you stand on this issue? Do you believe the benefits outweigh the risks? Or are you wary of excessive intervention in the free market? It's a question worth pondering, folks, because the decisions we make about financial regulation have a ripple effect, impacting not just the stock market, but the entire economy. Tell us what you think. Leave a comment below, share your insights, and let's have a conversation about how to strike the right balance between market freedom and stability. After all, in the grand casino of finance, we're all players, and understanding the rules of the game is crucial if we want to come out ahead.